quick recap from yesterday. Yesterday we talked about the deferral adjusting entries, which adjusting entries either deal with revenue or expenses. Deferral means the money has been there, but we're deferring the event. So any prepaid anything, money is there, we're waiting. Hi, you're here. How'd it go? Oh. The revenue producing deferrals mean someone's prepaid for something and now we have to produce the event. So season tickets to the Vikings games, those are prepaid revenue earners, and then as the Vikings games are played, we fulfill our deferred event. Accrual adjusting entries are complete opposite. What happens is either the revenue or expenses happen, we're just waiting for the money to come in. And if you're, well, I want to go back here. Revenues are for any work we've done. The money hasn't gotten there yet. Expenses that have occurred, the bills just haven't been paid. Okay. I'm going to skip that and we're just going to talk here. So find that in your notes. So again, we're talking accrued revenues. So the event that has will produce revenue has happened. I can't write apparently today. The money will come later. And it's very much under the accrual basis of accounting versus cash basis accounting. We're not going to wait to journalize just because the money hasn't been paid yet. We're going to journalize when the event happens. What kind of events? Interest that's piled up if we loan people money. Rent that eventually will be paid. Or of course any services that we perform that eventually will get paid. So take that same dentist example yesterday. Had I not prepaid for my crown to go in versus they put my crown in and they're waiting to get paid for me, that would be an accrued form of revenue. They've done the work, they haven't gotten paid yet. Why do we do this? When we perform services, but we haven't gotten cash yet. This whole understated, overstated thing, remember this is the if we didn't adjust. What would happen? It would look like we have less of assets than we really do, and revenues would also be understated. So in other words, eventually we're going to get paid, and so if we didn't adjust, that cash would look like it's lower than what it really should be. Same thing with revenues. So let me show you some examples of the adjusting entries. This is going to feel like, hello, we've done this before. That's why it's going to feel kind of easy. In October, Pioneer Advertising earned $200 of advertising services that they hadn't recorded yet. So it's simply AR goes up, service revenue goes up. So in other words, we've done the work, but it was not cash that was received. Rather, the alternative is, okay, a customer is going to pay us eventually, which we know is an AR. The next fiscal month, I guess, when we actually get the cash is the debit, and what's going to be the credit when someone who owes us pays their bill? AR. So you've done this type of adjusting entry, you just didn't know it was called that. The big thing here is what happened above this line. It's accrued revenue because we did the work. In this case, we performed advertising services. It's just that we weren't going to wait till the next fiscal period to journalize it. We're not waiting for the money to show up. We're journalizing when the event happens, whether the money's there or not. Okay, so then the last type, and there's going to be a lot of examples that go with this one. The last type of adjusting entry I'm going to talk about are the accrued expenses. Accrued meaning the event is there, money not there yet. And it's expenses, so it's business expenses that happen. Whether it's interest that's piled up, whether it's rent that we owe, whether it's that madness of salaries, and I'll explain the examples in a minute. So in other words, the events have happened, we just haven't paid them. The whole overstated, understated thing. If we didn't do these adjusting entries, it would look like we have less expenses than we really do, and it would look like that we owe less than what we really do. Let's talk examples, and I hope they're in your books. I see them there. The first one, this looks complicated. I'm going to try to simplify it as best as I can. This happens all the time. Pioneer Advertising Agency last paid their salaries, so they paid their employees on October 26th. So here was payday. The next payment of salaries will not occur until November 9th. But right here, this is a fiscal period change. This happens all the time. Let me use school for example. Our fiscal period ends on June 30th. July 1 starts a new fiscal period. I'm paid the 20th of every month. So there's a part of June that they kind of owe me, and it's going to time lapse over to the next fiscal period. It happens with payroll a lot. In this case, they're having, instead of fiscal years, they're having fiscal months. Okay, so payday is on the 26th of October. It's kind of creepy. This actually represents 2018, doesn't it? Is it the 23rd today? Yeah. Okay. Then our employees worked 1, 2, 3 days, and then we stopped because that's the changeover of the fiscal period. So they have earned, the event is that they've earned 3 days worth of work. We're not going to pay them, though, until the next 2 Fridays from now, because then in the next fiscal period, they're going to work 1, 2, 3, 4, 5, 6. Okay, they're going to have, so these two-week periods have a big old roadblock in between, and it's called a fiscal month change. The employees receive total salaries of $2,000 for their 5-day week, or in other words, $400 a day. Thus, we've gotten 3 days worth of accrued salaries piled up from the last time we paid them until the stop, and then we'll go to the next fiscal month. So we have to account for those 3 days that happened even though we haven't paid them, hence the accrued expense. This gets kind of complicated. I'm going to erase this so you can see what's going to happen here. How much money do we have to account for that happened? $1,200. We came up with that because we figured out it's $400 a day, and there's 3 days that have happened since our last pay period. So we've got to have a debit and credit. We know those amounts. It says $1,200. One's got to be an expense, and one's got to be pulled from the balance sheet. It's called salaries and wages expense for $1,200. Who do we owe money to? Our employees. So it's the salaries and wages payable. Payable on November 9th. The problem is that's the next fiscal period. So we have this little IOU to our employees, and for clean bookkeeping purposes, we have to say what happened. There were 3 days that they worked, and as employees, you don't really notice this kind of stuff, do you? But it's a big deal if you're running the books, because this represents, in this case, the fiscal month of October, or think of it like the fiscal year of 2018. Here comes the one that I wish they wouldn't talk about yet because it's got a whole chapter devoted to it, but depreciation. You drive around a vehicle that depreciates day by day that you drive it. It's just the nature of how the vehicle industry works, okay? Our school buses lose value, okay? These computers lose value every day that we use them, okay? Think of it all as equipment for our business. And there's lots of different ways to calculate depreciation. Actually kind of a fun chapter to teach, fun chapter to learn from because it makes so much sense to the real world. They're just giving you the number. They're saying, assume that depreciation on equipment for a year is $480 divided by 12 months. It's going to lose $40 of value every month. So we have to say that in October, how much is it depreciating? It's called the depreciation expense, $40. And a new kind of account that I would like to talk a little bit more about, the accumulated depreciation from the balance sheet, is also $40. I'm going to draw you a real cute little car here. Okay, here's the car. Here's the steering wheel. Okay, there's the little car. Beep, beep. Okay, I buy this car, and who knows? Let's say the car is $5 grand. Okay, on the balance sheet, that's going to be listed as a $5,000 piece of equipment. And it's always going to be listed as a $5,000 piece of equipment. If I had to make a T account, and I had to put E for equipment, okay, I'd say here is my $5,000 car. Not a $50,000 car, sorry. $5,000 car. This adjusting entry has nothing to do with the equipment, does it? Because our $5,000 car is going to stay a $5,000 car. You are just finally introduced to a new type of account. It's technically an asset, but it's called a contra asset. Notice its balance is a credit. Well, I thought assets had debit balances. They do. But do you see how this little $40 credit is going to offset the value of our vehicle? Let's say we bought this on October 1st. Yes, it's a $5,000 vehicle, but there's a contra asset that's offsetting its value. So what's the real value of this car after October? Okay, the 4,000, la la la, okay? It's a $5,000 car, but there's a contra asset crediting or devaluing it. What do? Month after month, we throw another $40 into a different pile, and this accumulated depreciation pile grows. You're still driving your little $5,000 car, but with it, like literally think of it like dragging a pile of devalued $40 month by month. Or like kick off the bumper so you can see it go over to the pile if that visual would help you. Okay? We will spend an entire chapter talking about depreciation, so I'm surprised they throw it at you right now, but they did, and I am not the textbook author. One more type. Are we still in our notes? Is it still there? Okay. Pioneer Advertising signed a 3-month note payable. Oh, $5,000 must be for the car. That was good karma there. I didn't plan that. So if I'm going to go borrow a $5,000 note payable from my bank, I'm going to pay 12% interest, and I am going to have this month, I'm going to have it paid off in 3 months. Principal times rate times time. It's a whole nother unit that I'm going to teach you about, something we talk about in personal finance, something we talk about in basic business. In the month of October, if I'm going to borrow this $5 grand for this car, I have $50 in interest that's also going to tack onto that, because when I borrow money from a bank, it is not free. I pay back the principal amount, $5,000, plus interest. I'm not paying this note off. I'm going to have it all of October, November, and December. I'm going to pay this note off at the end of the year, end of the calendar year, that is. But kind of like that accumulated depreciation pile grows a little bit, so does the interest that I owe on this note. So similarly, we have an interest expense and we have interest payable. And that was just for the month of October. In November, I'll have another $50. In December, I'll have another $50. So to borrow this money from this bank, every month that went by, $50 piled up. So I really owe them $150 plus my $5,000 back. So all of this, the events are happening, the money will come later, but we still have to adjust for time that happens. So to recap, do I have this in your notes? Yes. To recap, this is what I talked about yesterday. It is what I talked about today. If I have to draw a line through here, here is everything you need to know and memorize in relation to adjusting entries. Adjusting entries are necessary because we use them. Whether we use the actual thing or we use up time. You need to remember the rules. There needs to be a debit. There needs to be a credit for every adjusting entry. One of the accounts needs to be pulled from the income statement, which we know is either revenue or expenses. And also needs to be a balance sheet account, which is any asset, liability, or owner's equity. You learned today that there's a weird asset that we now can call a contra asset. You'll learn about more contra accounts. A contra asset has a credit balance because that $5,000 car really isn't worth $5,000 because there's a $40 credit that's offsetting its value because time passed. Above this line are considered the deferral adjusting entries, where the money is here, the event has not happened yet. Below the line are the accrual adjusting entries, where the event happened, we're waiting to get paid. It gives you a recap of what they're called, prepaid expenses or unearned revenue, accrued expenses. I see revenue, expenses. And then there's that recap of are they under or overstated. And remember, that simply means if we didn't adjust, so we did our journalizing, posting to the ledger, and made that trial balance. If we didn't stop and adjust to look at what passed with time or what's gone, our trial balance would be off. Even though the debits equal the credits and all the numbers are beautiful and they all shake out, there's more to the story because stuff was used and time has passed. So we have to adjust and create what you'll learn about tomorrow. It's called an adjusted trial balance. And then they give you examples of all of the entries. So that's definitely a memorizable table. And I think I have this in there one more time. And I think you wrote on that one already when I started the lecture early in the chapter. It's just, you got to think of this as a timeline. Event before the money. So event before money. Then the money comes. Or this is the money before the event. So that's it in a nutshell. I want to stop the recording. So it's just a clean cut. Let it time out. And then we'll start doing some end of chapter work. Yes? Like the examples are just like this slide.